Hey guys, today I'm going to be talking about the ProShares Bitcoin ETF that's just launched on the New York Stock Exchange. And not surprisingly, it's been very popular so far. On the first day of trading, it surpassed 1.1 billion in funds under management. That's reportedly the fastest any ETF has passed that $1 billion mark. So it's not the world's first Bitcoin ETF. Just in early 2021, the world's first physical Bitcoin ETF, the Purcell Bitcoin ETF, listed in Canada. But what makes Bitto such a big deal is it's the first Bitcoin-themed ETF to list in the United States, which makes it a lot more accessible to investors around the world. While Canada's exchanges are big, they're not as often offered by brokers outside of Canada. Because Bitto has just listed on the New York Stock Exchange, you just need access with a broker to US stocks in order to invest in the Bitto ETF. But before you do that, make sure you check out the rest of this video because I'm going to be looking at how this Bitcoin ETF works, how it compares to other ETFs like it, and why you should invest in it versus buying Bitcoin directly, if indeed you should. Okay, so what is it and how does it work? The Bitto ETF has been launched by US ETF provider ProShares, which is in turn owned by ProFunds Group. They specialize in alternative investment funds, such as ETFs that use derivatives to short the market. So they're kind of on brand by launching this Bitto ETF. Because although Bitto tracks the price of Bitcoin, there isn't actually any Bitcoin involved. Unlike traditional ETFs that own the underlying stocks and other types of assets, structured ETFs use derivatives to profit from asset price fluctuations. These ETFs are often used in commodity ETFs such as gold or oil price ETFs. Bitto is just one more type of structured ETF because it uses futures contracts to track the price of Bitcoin. There is no physical buying or selling of coin. So if 1 million people bought ETF units in Bitto, that wouldn't actually impact the supply of physical Bitcoin in the real world. It's worth noting that because it's not a physical coin ETF, it won't track the market or spot price of Bitcoin. Instead, it will be tracking the futures prices. A futures price is an agreement in a contract for a delivery of an asset, in this case Bitcoin, at a later date. So it's based on what market players think the future price of Bitcoin will be. This means the Bitto ETF price won't necessarily be an accurate reflection of the actual price of Bitcoin. And depending on how volatile the market is, it might differ quite a lot. For example, if a surprise crash happened to the price of Bitcoin, the ETF is likely to be slow to pick that up. Alternatively, if Bitcoin prices suddenly surged, it could also be slow to pick that up. Okay, so how does it compare to other crypto ETFs? Here in Australia, we don't actually have any cryptocurrency ETFs yet. So I thought I'd reach out to Jeff Yu. He's the CEO of Monochrome Asset Management and ex-Binance CEO. He's also working towards launching one of Australia's first Bitcoin ETFs. According to Jeff, while Bitto is one of the first of its kind in the US, there are actually around 70 cryptocurrency ETFs listed around the world. And there are three main strategies that they follow. First, there are physical crypto ETFs, and these are similar to more traditional ETFs where the underlying coins are bought and sold. And that's what you'd get with Canada's BTCC ETF. There are futures contracts crypto ETFs, which is what we have here. And then there are ETFs that hold stocks of companies that are exposed to blockchain or cryptocurrency technologies. So these ETFs would be the least aligned with cryptocurrency prices, but the easiest to launch since there are less regulatory hurdles to overcome. So as we know, Bitto uses the second option. It uses futures contracts. And Jeff says there are both pros and cons to this strategy.
It tracks the CME Bitcoin futures contract prices. The pros of that, it has lower custody barriers since it's just holding a well understood financial product, being a futures contract. But during price shocks, it has weaker resistance from the decoupling risk to the true Bitcoin price because it's not physically backed. And we've seen this problem in the gold ETF market before. And also you have to factor in the rolling over cost of the futures contract, which may be significant, causing the price divergence to happen over the long time and not track the price of true Bitcoin closely as a spot-based ETF.
Okay, so why would you invest in this ETF versus buying Bitcoin directly? That's the question everybody wants to know when it comes to these ETFs. And look, it's a really good question. So I put it to Jeff, who said it mostly comes down to access.
As buying Bitcoin directly obviously has its pros, which is you can control your cost base, the trading cost, the custody cost, the insurance cost. But it's not the most accessible method to market for a lot of people that wants exposure at this age. Most people are traditional regular investors that don't have the time to manage the compliance and custody and operational risks of managing their own holdings. So the downside factor is that you have to consider with holding Bitcoin directly is the risk. The code-wise, Bitcoin is secure. It's known to be the most secure protocol-wise. But in terms of how you secure it, who do you trust, and what's the disaster recovery plan? These are things that most regular investors don't have the expertise and don't have the mental capacity to follow up with all the spouse. So investing just in an ETF may cover a lot of those concerns, and they pay a small management fee to solve that issue for them.
Basically, investors that have little experience with cryptocurrencies and maybe don't have a cryptocurrency exchange can now add exposure to their portfolio through any regular stockbroker account. But there are downsides here, like the fact that you're tracking a future price rather than the actual price. That comes with extra risk. And there are also extra costs. As with all ETFs, there are a couple of fees to consider. Aside from the brokerage fee you might be charged depending on what broker you go with or what platform you go with, there's also the management fee that is charged by the ETF issuer. The BITO management fee is 0.95, which isn't the highest management fee, but it's well above average. The average ETF fee here in Australia, for example, is 0.5%, and in the US it's even lower. Since you don't need to pay a management fee when buying physical ETF directly, that's a definite downside. On the other hand, you're hoping that the fund managers that are looking after BITO are doing a good job in keeping it all secure. That might be worth the extra cost to you, as opposed to you jumping into a cryptocurrency exchange and buying it up directly yourself, especially if you're looking to invest a lot of money. Okay, so how do you invest in it? To buy units in the BITO ETF, you just need to be signed up to any stockbroker that has access to US markets. That would be all brokers in the United States, but outside of the US, not all brokers offer US stocks and ETFs, so it definitely pays to check. That's it from me. If you like this video, don't forget to hit the like and subscribe button. And keen to hear from you in the comments below. Are you thinking of investing in this? Why or why not?